Hi, I'm Sue Odom. I'm a tax and employee benefits lawyer here at Nexsen Pruitt. Severance benefits are very common. Maybe these benefits were a negotiated part of an executive employment agreement. Maybe severance is being offered in connection with a plant closing or involuntary termination of employment. Or maybe severance is being offered to settle employment claims. Regardless of the reason, care should be given to considering the tax and ERISA law implications of the offering. Many employment lawyers are not familiar with these laws, yet these often missed issues have potentially costly implications to employers and the affected former employees. Let's take a high-level look at some of these issues. The most common mistake I see is the failure to identify or consider all the laws that apply to severance benefits. Severance benefits are not just an employment law issue. Some severance benefits are governed by ERISA, the law that applies to employee benefit plans. Others are not. For the ones that are, some are treated as pension plans while others are treated as welfare plans. It's important for you to first determine what bucket your severance benefits fall into because each bucket has different compliance requirements. For example, severance benefits that are treated as ERISA-governed pension plans are subject to ERISA's reporting requirements. The failure to meet those reporting requirements could result in the imposition of significant penalties. Some severance benefits are subject to 409A of the Internal Revenue Code. Others are not. Again, if the benefits are governed by Section 409A of the tax code, they correspondingly are subject to strict rules for the distribution of the benefits and prohibitions on accelerating payouts, for example. Some severance benefits are subject to 457F of the Internal Revenue Code, while others are not. Section 457F very generally applies to tax-exempt or governmental employers that promise severance benefits payable upon termination that are of a certain size and are payable over a period exceeding 2 years. This tax law rule may subject the benefits to accelerated taxation in the year of termination, even if the benefits are paid over a period of years. It therefore is extremely important for employers to make this determination as it affects employee withholding, payroll taxes, Form W-2 reporting, for example. Severance pay also is not subject to deferral or treated as compensation for retirement plan purposes. This means that 401k salary deferrals should not be taken from severance pay. If such deductions are taken, an operational failure has occurred for the plan, it should be corrected using the IRS's correction program, which is the Employee Plans Compliance Resolution System, or EPCRS. As referenced above, severance benefits are generally characterized as Form W-2 wages. However, Revenue Ruling 2004-110 establishes an exception that it provides that if the employee provides clear, separate, and adequate consideration for the employer's payment that is not dependent upon the employee-employer relationship, then it is not wages. However, that rarely occurs. And in that particular ruling, the IRS concluded that payments for canceling an employment agreement is wages. Again, anytime an employer offers severance benefits, they should pause and think about these important issues in consultation with an employee benefits lawyer. Thank you.